On the screen we have non-current assets, and of course we begin by appreciating what is a non-current asset. Now in our field as accountants, we have improved on the terminology of fixed assets. We now refer to these assets as non-current assets. Now, what you include as a non-current asset is that asset which you intend to use on a continuing basis. If the business intends to use an asset on a continuing basis, it is regarded as a non-current asset. Though in some of these old accounting systems, for example, if you look at QuickBooks, if you look at Tally, we still talk about fixed assets. We are still using that language, but the accounting, the conceptual framework has been improved to include new terms and new classifications of assets. And today, what your professor at the university was referring to as a fixed asset, when you join the profession, we say this is now regarded as the non-current asset. Now, non-current assets covers both tangible and intangible assets. Covers both tangible and intangible assets. Now, it means that any other asset that does not meet the definition of a non-current asset is going to be referred to as a current asset. According to the conceptual framework of accounting, current assets are assets that will be realized, consumed, or sold in the normal operating cycle of the business. Current assets are assets that will be realized, consumed, or sold in the normal operating cycle of the business. Or we can look at current assets as assets that are held with a primary objective of trading. Primary objective of trading. Now, in line with this classification, we would think of current assets to include things like inventories, trade receivables, prepayments, cash at bank, cash in hand. Those are typical current assets. We hold those assets because we want to utilize those assets within the financial year. Now, in the same line, when it comes to the non-current assets, it means that you're talking about things like land, buildings, fixtures and fittings, furniture, plant and machinery, motor vehicles, investments, software, computers, etc. etc. Those are non-current assets. So the engineers here, when we talk about a non-current asset, we are talking about things like land, buildings, fixtures and fittings, furniture, motor vehicles, investments, software, computers. All those are non-current assets. And then the current assets, as per the screen, include typically inventories, accounts receivables, trade receivables, prepayments, cash, bank. All those are current assets. Now, If I decide to purchase, uh, a motor vehicle or furniture, I will have incurred an expenditure. If I decide to pay for rent, repairs and maintenance, I will have incurred an expenditure. All those are expenses. But in our field, especially the professional practice, we draw a line between capital and revenue expenditure. We draw a line between capital and revenue expenditure. So, our discussion will delve into capital revenue expenditure. Let me start with capital expenditure. Capital expenditure, very important, forms part of the cost of the asset. The term is capitalized. So, capital expenditure is the expenditure which forms part of the cost of the non-current asset, and this expenditure is recognized in the financial statements at cost. We don't expense this expenditure. We add it to the cost of the asset. And for that reason, when we talk about cost of an asset, if we talk about cost of an asset, we are talking about the purchase price, we are talking about the cost of importing, assuming it is coming from outside countries. We are talking about the cost directly attributable to this asset, such as insurance, installation, housing, transportation. We are talking about the cost you're going to incur in dismantling that asset and restoring the site to its original state. So if the examiner gives information regarding purchase of a plant and is indicating to you that the plant was purchased on this price, these were the taxes incurred, non-refundable. Those of you who have already done taxation, you know that we have refundable and non-refundable taxes. So the non-refundable taxes form part of the cost of the asset. Insurance, installation, warehousing, transportation. I'll share the slide so that you can pick up this pro forma. So, before you record in the financial statements the cost of an asset, ensure that you have captured all these costs because they are elements of the total cost. When we purchase an asset, as I've mentioned, you have incurred capital expenditure. And if it is capital expenditure, it means that the double entries will be aiming at capitalization of that cost. So you debit the asset, credit cash, bank, or payables, depending on the mode of payment. If you have not yet paid, then it becomes a payable. Very, very important accounting entries here. I'll share the slide. Now, I've mentioned that capital expenditure is totally different from revenue expenditure. Revenue expenditure would include things like rent, repairs and maintenance, transport, meals, refreshments, depreciation, and any other operating expenditure. That expenditure is revenue expenditure. And according to the generally accepted accounting practice, revenue expenses must be expensed. Revenue expenses must be expensed. Therefore, revenue expenditure is the expenditure you incur for the purpose of the trade or to maintain a non-current asset, like repairs and maintenance. When you repair a non-current asset, like a motor vehicle, that's revenue expenditure. You have incurred the expenditure to maintain. When you paint your office building and you give it a new face, you are maintaining the building. That is a revenue expenditure. Revenue expenditure should not be capitalized. Don't make that mistake. Do not capitalize. Do not capitalize revenue expenditure. It does not form part of the cost of the non-current asset. Okay, now the accounting entries. The accounting entries to expense revenue expenditure is debit that particular expenditure, like repairs, maintenance, transport, airtime, meals, refreshments, debit. Then you credit the mode of payment. Did you pay by bank? Did you use cash? Are they demanding you payables? That's the credit. But of course, I know from the rules of double entry, we are still maintaining the rule that when expenses increase, we debit the expenditure account. Now, I need to mention at this point that revenue is also classified as capital or revenue income. Actually, income, because revenue is income. So income is classified as capital or revenue. Now, income is capital, or we have capital income if these relate to proceeds from the sale of a non-trading asset. You know that entities time and again sell their non-current assets. For example, computers, motor vehicles. It's not that you're dealing in motor vehicles, no. You're just disposing of, maybe they have reached the policy life. Policy life, like some companies, they don't use vehicles which have spent like 5 years in use. A vehicle reaches 5 years in use, it is disposed of and they get a new one. Some of you are working for those powerful companies. Others, you're working for companies where the vehicle, managing director's vehicle, has reached 20 years and the guy is still moving it. That is a bad practice. But I'm saying furniture, computers, machinery, yeah, time and again you may sell them off. So those are what we call non-trading assets. It's not that you're dealing in those items, no. So the income you get from the sale of those articles is what we refer to as capital income. The profits losses from the sale of non-current assets must be included in the income statement of the business for the accounting period in which the sale takes place. When you see your organization disposing of an item of non-current assets, International Accounting Standard 16 requires you to compute profit or loss on the disposal. We shall be doing that. The business may sell vehicles or machinery which it no longer needs. The proceeds will be capital income. That's the point of emphasis. Meaning that income can actually be revenue in nature. That's why when we are preparing our financial statement, we call that item the sales. The sales are referred to as revenue. Revenue. And you will find disasters that some of you are going to go into audit. You find a lot of disaster where people are including under revenue income from sale of non-trading items. That is totally wrong. Revenue income is revenue that has been derived from the following sources. Revenue income is income that you have derived from the following sources. Number one, the sale of trading assets, such as goods sold in inventory, the provision of services, for some of you are into services, interest and dividends received from investments held by your business. We know that your business actually has that policy of investing surplus funds or buying shares in another company. So in that way, you may receive interest, you may receive dividends. So that is part of revenue. Now, capital income is from the sale of non-trading assets, non-current assets. Capital expenditure is from the expenditure incurred in the purchase of non-current assets. That is a point for you to note. Revenue income is income from sale of trading assets, provision of services, interest and dividends. Revenue expenditure is expenditure incurred in maintaining non-current assets, and revenue expenditure that has been incurred on current assets like inventories, purchases. If you purchase, you write off debts, the receivables and so on. So that leads us to depreciation. Depreciation is part of the discussion, and depreciation is a concept. It refers to the systematic allocation of the depreciable amount of an asset over its estimated useful life. As I've mentioned, capital expenditure is recognized as part of the cost of the asset. But we know this asset is going to be used over a number of years, which we are talking about here as the estimated useful life. We believe as accountants that as you use the asset, it keeps on losing value. But before we look at the depreciation methods, we shall first of all understand what's the meaning of the depreciable amount. How do I arrive at the depreciable amount? Now, the depreciable amount of a depreciable asset is the historical cost or other amount substituted for the historical cost in the financial statements less the estimated residual value. So this is the formula. I say formula here. I don't know whether you are seeing a formula as well. If the examiner wants you to compute the depreciable amount, get the historical cost subtract the residual value, remove the residual value. That's your formula. That's your formula. That is what we depreciate. Please note that if the residual value is not given, this one you're not going to find it, even if I share the slides. If you're not given the residual value, take the residual value as what? In the chart, Emma says 0, take it as 0. Farida says 0. Any other person? Any other person? The examiner does not give the residual value. We take it as nil. Depreciable assets. Not all assets are depreciable, members. Not all assets are depreciable. Depreciable assets are assets which are expected to be used during more than one accounting period. So you cannot depreciate inventories. You cannot depreciate the bank. You cannot depreciate cash. It's not possible. Why? Because those assets are used during the year. But an asset is depreciable if it is expected to be used during more than one accounting period. A depreciable asset is an asset which has a limited useful life. Has a limited useful life. And the asset is held by the enterprise for use in the production or supply of goods and services, for rental to others, or for administrative purposes. Now, if the examiner wants me to define depreciable asset, am I supposed to put all this down? Yes. Useful life. Examiner may want you to define what is useful life. The period over which a depreciable asset is expected to be used by the enterprise, or the number of production or similar units expected to be obtained from the asset by the enterprise. Now, what I need to mention here is that useful life is estimated. That's why we are using the word expected. Residual value, there is a formula in here. We are saying that the residual value is the net amount which the entity expects to obtain for an asset at the end of the useful life, after deducting costs of disposal. After deducting costs of disposal. Now, as I've mentioned, as part of your work as an accountant, you will have to depreciate. You will have to depreciate your assets and recognize that loss in value. In accounting, we believe that at the end of the year, if the computer was purchased at 4 million, you have consumed part of that 4 million. You have consumed that part of that, the part of that 4 million. So the amount consumed is the loss in value and is the depreciation. So how do we arrive at the depreciation? The depreciation methods that are going to be examined, but there are many others. We shall examine the straight line method, reducing balance method, sum of digits method. So as you're going for the exam, we expect you to have good understanding of these depreciation methods. So we shall discuss this, but of course, there is no way we can do it without an activity. So activity number 1, we have a lorry bought for business at a cost of 17 million. This lorry is expected to last for 5 years. At the end of the 5 years, it will be sold for scrap at 2 million. We are required to work out the depreciation to be charged for each year under straight line method. Reducing balance method, you need the rate. Reducing balance, you need a rate. It must be given. Sum of digits method. So I want you to take off 4 minutes, put down the activity, type in the chat if you're done. We go into the computation.